In this video, I'm going to talk about free cash flow to equity method. Last video, we discussed the dividend discount model. Both of them are common in the sense that we are trying to measure the cash flow available to equity holders. Of course, there is an indirect method called FCFE, either go to WACC or APV method, but those are something waiting for you in a couple of videos later. We first go through this direct measure. Why don't we just compute the cash flow available to equity holders by using dividend, as a whole? The answer is, dividend discount model, there is a problem. Number one, there are many companies, significant portion that just doesn't pay dividend. They don't pay dividend for growth. High growth companies, they cannot afford to pay dividend. Number two, even if they pay dividend, they don't pay 100% of their net income as dividend because they have to save some money and then reinvest for future growth, right? So dividend is really a conservative measure of cash available to equity holders. So please remember that part. By doing dividend discount model, you are more likely to get a lower bound, lower bound of valuation. I told you before, valuation is about estimating with some errors. There should be upper bound and lower bound, and dividend discount is more likely to be the lower bound of your valuation number. And then free cash flow to equity. Then you may wonder, why not we just work with net income? Because dividend is paid based on net income usually. And the net income is net profit, and then it's familiar to you. You learned about accounting basics and income statement. That's the bottom line, right? Why not we just work with the net income? Well, the answer is no, because accounting rule is accrual basis, whereas finance guys, we take the perspective of cash basis, right? Because what matters to finance guys is that whether we can raise capital today in the market. How can we raise capital in the market today, not in history? And that's why we need to take the perspective of current market investors. So market value, matters much more. And accounting statement in that sense has a limitation because thinking about depreciation and amortization, those are something, the cash expense already happened like 10 years ago in the form of CapEx. For example, when you do a business, and then you purchase an equipment and factories and land and that to produce some goods, right? Let's say you spent $1 billion to purchase this machine, that generates, the products, right? Over the 5 years, right? $1 billion, and you're going to spend it, use it for 5 years horizon. Then, well, in income statement, you don't recognize this $1 billion right away. You just recognize it in your cash flow statement, but in the income statement, you only recognize its depreciation and amortization. I told you $1 billion, and then it's going to be useful over 5 years. So divide it by 5. So $200 million depreciation and amortization will be recognized over next 5 years. Why do we do that? Because accounting has a matching principle. Your revenue and cost has to match each other. That's different from cash-based, recognition. So we have to readjust these procedures. So capital expenditure, recognize it right away, and then depreciation and amortization, well, add back to your profit, because you did not spend that amount of money. So that's what's coming up in this adjustments to get to the free cash flow to equity holders. That's the biggest part, net capex part. So let's go one by one. Some analysts assume that the earnings of a firm represent its potential dividends. This cannot be true for several reasons. Number one, earnings are not cash flows since they are both non-cash revenues and expenses in the earnings calculation. Number two, even if earnings were cash flows, a company that paid its earnings out as dividend would not be investing in new assets and thus could not grow. Number three, valuation models where earnings are discounted back to the present will overestimate the value of the equity in the firm. Okay, so the potential dividends of a firm are the cash flows left over after the firm has made any investments it needs to make or to create future growth and net debt repayment. Debt repayment minus new debt issuances. You have to make some adjustments. Okay, so tell me about the formula. You're Korean students, I know. Let's go to formula. Yes, free cash flow to equity model. So FCFE should be the residual cash flows after meeting all operating expenses, tax, reinvestments, and debt obligation. First of all, tax, right? You don't want to piss off the government. So let's start with net income because it's after tax, right? And then you add back depreciation because it's non-cash expenses that you just recognized in your income statement before. Now, subtract the capital expenditures because you did not subtract the capital expenditures right away. Okay, you just only recognize it in your cash flow statement. Bring it here, man. And then subtract change in non-cash working capital. We're gonna talk about it a slide later. Wait for that. And then net debt issuance should be added here. Okay, the last item over here. Net debt issuance. What do you mean? Well, wait for that. Depreciation and amortization are added back because they are non-cash charges. Firms constantly reinvest cash flows from operations as cash expenditure to maintain growth. CapEx should include the money spent on acquisition, and an increase in working capital tie up a company's cash flows. Okay? Working capital, what is that? Please wait. This is about inventory. Okay. And then taxes and interest obligations are deducted. Okay. Interest expenses and debt repayments are deducted. And then debt repayment may be fully or partially financed by the issue of new debt, which is treated as a cash inflow. Whatever you borrow from the bank, right? Now it's available for use for company, the equity holders, and you can, it's at your disposal. It is a cash flow available to be paid out as dividend. Okay, if you look at some cases of leveraged buyout, well, LBOs, what do they do? If you look at the Barbarians at the Gate, the movie, right? They borrow huge amount of debt from the banks and then they pay out as dividend. Okay. Why is that the case? Shouldn't the company try to repay the debt as soon as possible before they pay out as dividend? Yes and no. Okay, there's an agency cost problem associated with this capital structure issues. We're going to talk about that later, but I'm talking about some extreme cases. The borrowed money from the bank can be used as dividend payment sometimes, right? Like that. So, what is the reinvestment, by the way? Reinvestment is about, investing for your future. That future can mean either long-term or short-term. Okay, CapEx, capital expenditure, is about a long-term investment, reinvestment. Factory, land, and then what is it? The um, new company that you acquire. Okay, M&A that you spent. Okay, that's down and out capital expenditure. In cash flow statement, you will have a separate item, okay, called M&A, acquisition that you have to spend. Okay, that is a part that should be part of your capex in your calculation over here. And that also tells us the flip side of the same coin, which means if you sold off your division, unprofitable division, and then sold your division to other companies and got money out of it, that is called a divestiture. that divestiture, and then if you received cash, that's going to decrease the capex. So capex should be the net amount of your down and out capital expenditure and acquisition amounts that you spend minus the cash received that you from your divestitures, right? So that's capex. And then the second item about reinvestment is the change in non-cash working capital, short term. Okay, what is that about? Well, first of all, non-cash working capital. What is that? Well, that's inventory. The way I understand it is it's inventory. Okay, look at the Levi's store. Okay, I just went there, one of them, over the weekend, and then I found out a lot of blue jeans, right? Um, and on the shelf, okay, the garments on the shelf, right? They are ready to be sold off, but it doesn't sit there like 10 years or something. No, we call them, if that happens, it's bankrupt, okay? Usually those inventories will be sold off within a month or less, right? They try to, okay, make it quick so that they will be, cashing it out very quickly. But the important thing is inventory is something you need to grow your business in the short term. No inventory, no sales. Okay, you have to make sure you have enough of inventory at the same time. Okay, so inventory is for the short run growth. It's a kind of investment to have an inventory in the first place. But the thing is, the inventory does not happen all alone. Well, you have to purchase the material on credit, and that's what we call accounts payable. And then you have to sell those inventories on credit, which is called accounts receivable. So accounts receivable and inventory, they sit on your current assets section, and then accounts payable, that sits on your current liabilities section. And then these three has to be aggregated in this form. Working capital being equal to AR plus inventory minus accounts payable. Okay, and then what matters from cash flow perspective is not the balance of working capital, but the change in working capital, because you want to measure how much cash that you want to spend to build your inventory, set up your inventory. So change in working capital is something you have to subtract. Okay, it drains your cash flow. Okay, so you need to calculate the change amount of working capital. And watch out, this is awfully confusing to many people because it is the change, not the level, okay, that you have to include in the formula over here. Okay, change in non-cash working capital. Okay. All right. And then FCFE, this is a free cash flow to equity. And then a more detailed explanation about it will follow in the next video. So thank you for watching until now. See you. Bye-bye.